I'm Julian Beron, the CIO of the core fixed income team AllianzGI, and I'm joined by my colleague Luke Copley. Together we serve as the lead portfolio managers for the strategy. After so many years of supportive policies for fixed income, we're in the midst of a big bond reset. The speed to which central banks have moved into inflation fighting mode has caused total returns to be quite negative across the asset class. Having been absent, missing in action for over a decade, inflation is back, and this is causing risk premia to rise across global bond markets. We should expect central banks to remain very data dependent, which is causing some nervousness in the market. And as we go through this process of policy tightening and greater price swings, it's great for us to be able to operate a global bond strategy with high flexibility, especially with regards to duration management, and to enjoy a global universe, including credit, to exploit cross-market opportunities as market cycles start to diverge across the globe. And now over to Luke for an update about our strategy and our market outlook.
Well, the rising rate backdrop has left very few places to hide this year. It's been really tough. But we are now seeing some opportunities in relative value rate strategies, recognizing that some rate hiking cycles are definitely more advanced than others, and that the inflation problem is not uniform globally. So, for example, the energy price crisis impacts in Europe and in the UK are certainly a lot worse than in the US. So we could argue that the European Central Bank, the Bank of England, have a lot more to do in terms of policy tightening, and we're positioning for European and UK bonds to underperform the US. Elsewhere, if we look to Japan, for example, we're now seeing a global outlier in terms of the ultra-accommodative monetary policy that's still in place there. So we're positioning for higher Japanese rates as well. In terms of credit risk in the strategy, that's quite defensive for now, as spreads continue to react to the weakening macro backdrop. That said, there are some pockets of opportunity now opening up, particularly in euro credit, where spreads are now back above the COVID crisis wides in some situations. We particularly like reverse Yankee bonds, so those are typically US corporates that have issued euro-denominated bonds, where the risk return looks quite compelling. Well, the exciting development here is that value has now been driven back into bonds. Core government rates, even adjusting for inflation, i.e. looking at real yields, are positive in many countries now for the first time in years after being negative for so long. So the return outlook for bonds is looking increasingly attractive. We are minded to stay defensive for the remainder of this year, just on the risks of another final leg higher in bond yields. But as we get into 2023, the prospects of a deep recession could then trigger quite sharp recompression of yields, which we'd be hoping to capture through all of the active duration flexibility